In this video, we're going to talk about shared appreciation mortgages, otherwise known as SAM loans. So a shared appreciation mortgage is any mortgage in which the lender, right, so the bank or whatever organization doing the lending, gets a portion, right? They're going to get a percentage of any increase in the property's value, right? So if the property is a home and the home were to go up $30,000 in value, then the lender would be able to get a percentage of that. And whatever percentage that turns out, that's something that was going to be negotiated in the loan itself, right? It might be 10%, might be 15%. So not all lenders offer this type of loan. And usually has to do with, like, maybe it's a shopping mall. So it's some kind of commercial project. The lender says, oh, I want to do a SAM loan for this. I think the shopping mall is really going to go up in value. Or it might be some kind of subsidized or affordable housing program that's run by a government. So it might be an affordable housing program by a government or by a nonprofit agency. And I'll talk about the ways in which they would use the SAM loan. So this I think is really easier to understand if we were to walk through an example and give you a mortgage so you can kind of put it together mentally. So let's say that you have, or you're wanting to buy a house and you really want a 30-year mortgage and you're needing to borrow $120,000, right, to buy this home. And so you take a look and you say, you know what, given my credit worthiness and the market right now, the market interest rate for a loan that I want is about 7.5%, right, 7.5%. And so if you were to get a 30-year mortgage, $120,000 at 7.5%. Let's say let's see here, your mortgage payment on a monthly basis would be $838.80. I believe that's correct. So this would be your monthly payment, right? This is your mortgage payment. So you say, hey, that's kind of high. I don't know if I can quite afford. Is there any way I could get this down? Is there any way I can get this number cheaper? And a lender says, you know what? Yeah, there is a way we can reduce this for you. And so the lender says, I'll actually give you a rate of 6.5%, right, instead of 7.5. And you say, hey, that sounds wonderful. If I were to get a 6.5%, that would change things, and then my monthly payment would be $758.40. So now you're reducing your payment here. So it looks like this is reduced by about $80.40. So you're saving $80.40 a month, right? So you say, hey, you know what? This is a little more affordable. I think that I can handle this $758 payment. But here's the catch, right? The lender obviously is giving you a below market interest rate, right? So they're giving you a benefit, so they're going to want something in return. And they say what we want in return is 15% of the property's appreciation. And appreciation is just, let's say, okay, so let's just assume there was no down payment here and that the house was just valued at $120,000. And then let's say that a couple years later the house is valued at $160,000. Then you'd have $40,000 of appreciation. That's all we mean when we're talking about appreciation. We're just talking about the increase in value of the home. So the lender is saying, look, if this house goes up in value, right, we're going to take that difference here, that appreciation, that increase in value, we want a percentage of that. We want a piece of that. We want 15%, right? So it'd be 15% of this $40,000. And that's what we're demanding in exchange to give you a 1% break on your interest rate here. So they're not giving it to you for free. So if you're a visual learner, it might be a little easier to understand. So this is you here. And so here's the bank. It could be any lender though, and they're giving you a lower monthly payment, right? So they're giving you an interest rate that's lower, and you're giving to them a percentage of the home's appreciation. And like I said, it doesn't have to be 15%. It could be 20, it could be 10. These are the things you negotiate with the lender. And so when we think about who would do a SAM loan, why would this be beneficial to you? Well, what if you don't expect to live in the home for very long, right? If you say, I'm not going to, let's see. not living in home long. Right? And why might that matter? Well, if you're going to live in the home for 30 years, if that's your expectation, then there's going to be a lot of appreciation, right? Over time, 30 years, your house value will go up, right? They'll go up and down, right? There'll be peaks and valleys. But after 30 years later, right, just due to general inflation and so forth, your house is probably going to be worth more. So if you're not living in the home long, that means there's going to be less appreciation. And if there's less appreciation, then you're giving the bank less, right? Because what you're giving them in exchange for that lower interest rate is a percentage of a piece of the appreciation. And if you're only going to live in the house a few years, then you obviously would be giving away less in exchange to get that interest rate. Now, you might be saying, hey, wait a minute. What if I were to just pull a fast one and say, well, I'll just never sell the home, right? I just won't sell the home. I'm going to live there forever. I just won't sell the home. And then I never have to give the bank a percentage of the home's appreciation. Well, banks have thought of that. And so what they'll have is they might have something written in it. They say, like, after 10 years, regardless of whether you sell the home, so let's say if not sold, if home not sold, then bank gets, let's say, 1/3 of the appreciation or something. 1/3 of appreciation. Now, again, this depends on the contract you have with your particular lender. This is just to give you kind of an idea how this might work, right? So if 10 years go by and you say, I really like this house, the bank's not going to say, oh, I guess we never get any of that appreciation. They're going to have something written in the contract, for that contingency saying, okay, well, we'll have the home appraised, right? We'll have an appraiser come out, get a valuation of the home, and then if it's appreciated, we'll take 1/3 of that. Now, you might say, well, what if market conditions are such that the home is worth less? Or what if I sell the home for a loss? So if you sell for a loss, this is something really important that you need to think about and factor in, because you could take on considerable risk here. If you sell for a loss, you want to make sure that you have in the contract that you are not obligated to pay the bank anything with regard to this whole appreciation deal. Now, you might say, well, hey, it's obvious the home hasn't appreciated, therefore I don't have to pay anything. Well, you want to make sure that that's in the contract, right? So sell for a loss, no obligation to the lender, right? You want to make sure that that's in the fine print, and so that if it's not some kind of issue where you end up owing the bank money anyways, or they try and block what you're doing, or there's some kind of problem, you want to make sure that it's just understood in advance, hey, if I sell this house, if it's actually depreciated in value, then I'm not going to have any obligation to the lender with respect to this shared appreciation clause. So those are some important things to think about. And just, sometimes even with affordable housing, you can kind of have a clawback, right? So affordable housing, when we think about affordable housing, usually you're getting some kind of subsidy, right? So affordable means you're getting some kind of subsidy from this agency, from the government, right? So they're giving you down payment assistance, or they're giving you a lower interest rate. There's something, it's kind of like for a public interest, right? There's a nonprofit or a government agency. They're trying to help you. They're trying to foster home development. So if you say, oh, I'm going to do that, and then I'll just sell the house or something, and I pocket the money that I made, well, they have things in place. They'll have like kind of a clawback provision. Let me just explain. So let's say that you had an organization, a nonprofit, that said, look, we want to get you into a home, right? You have trouble coming up with a down payment. That's okay. We've got a down payment assistance program. Well, we'll take care of the down payment for you to get you into a home. And you say, hey, this is wonderful. They're going to give me $10,000 to make the down payment on the house. And then, of course, you are responsible for the payments afterward and so forth. But you're getting free $10,000 here to buy this home. That's part of the affordable housing program. But then you say, hey, you know what? I'm going to sell this house. You sell the house 2 years later, and you get $140,000. Hey, the real estate market is booming in your area. The house has gone up $40,000 in value, right? So now the lending agency was kind of, hey, look, you got kind of a benefit here, right? We subsidized. We paid $10,000. We paid 10% of the cost of that house for you, and then now you just turn around 2 years later and you sell it, And not only did you pocket that $10,000 that we gave you, you're also now getting this $40,000 appreciation. And they're just saying, we think that we should get a piece of that because we try to do this as public good, not so people can flip houses and stuff. And so really they say, okay, well, look, we want the $10,000 back, right? The down payment assistance that we gave you. We're gonna take that $10,000 back. Plus, in addition to that, we want a share of the appreciation, right? Plus that share of the appreciation. Now you might say, well, how much of the appreciation? Well, typically they'd say, look, how much of the house did we subsidize? Well, 10,000 out of 100,000 is 10%, right? So they subsidize 10%. So it stands to reason they should get 10% of the appreciation, right? In the appreciation, the house went from 100,000 to 140,000. So there's 40,000 in appreciation, and then you multiply that by 10%, the amount of the house that was subsidized, and so they get 4,000. Now the 4,000 is the piece of the house that went up, right? That's their share of the appreciation, and they're actually saying, well, we're going to take that 10,000 back for the down payment assistance as well. Now, again, need to stress, it depends on your lender, or it depends on the agency you're working with. So you want to make sure, don't take these numbers at face value and just say, oh, well, it's going to be 10% appreciation. This is what you negotiate with that agency or with your lender. And so just make sure that you understand what these numbers are. And so if you were to engage in a shared appreciation mortgage, you make sure that you don't have any kind of obligation if you end up selling for a loss. And you understand that you are giving away a piece of the appreciation of the home's value in exchange for a lower interest rate or something like down payment assistance.